Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer, and today we are going to be analyzing Visa stock. This one came in by request down in the comment section of one of my other videos. If you have a request, just drop it down in the comments, and I'll get it on the list on the whiteboard behind me, and eventually I'll make a video analysis where I share my thoughts. If it's a stock that's in the S&P 500, I post those here on YouTube for free. If it's not in the S&P 500, I post those on Patreon, which is $5 a month, and if you join there, you can get a big discount to the full Cyclical Investors Club service on Seeking Alpha, where I have all my spreadsheets, a chat room where you can chat with me, and a bunch of other articles that are not public. As always, this is not individual investing advice. This is just how I personally analyze stocks, and I'm showing you exactly what I look at when I decide whether to buy a stock or put it on a list to track to maybe buy in the future, anything like that. So with that said, let's get into the analysis. So the first thing I always like to check is the historical earnings cyclicality, which is going to be represented by this dark green area here on the fast graph. And Visa really hasn't been very cyclical during COVID. What I'm looking for here are drawdowns in earnings year over year. Earnings fell 7%, which is totally understandable given all the worldwide disruption that was going on. For the most part, this has not been a very cyclical stock at all. I would describe it as a secular growth stock because it really, other than this one exception, has only gone in one direction, and that's up in terms of earnings growth. However, these guys went public in like 2008, I think. Yeah. And so we don't have data on what would happen during an actual recession. Now, just generally speaking, you would assume that they would be somewhat cyclical during a downturn. And so when I do this, what is MasterCard MA? Yeah. So MasterCard just went public a little before them. And they also, let's take a look here actually. So their earnings weren't very cyclical, but their stock definitely was during the Great Recession. I think it fell 60% off the top of my head. It's been a while since I looked at it. Yep, man, good memory there. Okay, so I'm gonna look at MasterCard in my next video. But we can see that we could expect an opportunity, a sell-off. I mean, if you look at the PEs, post there, they're down in the low teens. Not super cheap, but worth paying attention to. Another stock maybe worth looking at is this. It's not this, like MasterCard's the best example, but because American Express actually does have like a credit card service, and that's not actually what Visa and MasterCard do. They're more like processors, like transaction processors. We can see that American Express is definitely cyclical, more cyclical. So they are economically sensitive, but and I think the bigger they are to some degree, the more economically sensitive they become. So it's worth to keep that in mind, that the stock price especially can be volatile during downturns. That's what I would expect. Even if earnings aren't super duper cyclical like in American Express. Okay? But what this tells us is we can use earnings to, let's just see if we can do it here. So the PE is 28. Is there another spot where it's 28? Pretty close here. So you can use earnings as a rough guide. You can see it basically goes up to the right. You can see that if you pick a similar valuation, you're going to get like a 17% growth. It's a little bit more expensive here. And if you look at this recent year, like 17, 17, 18, that's basically what earnings have been growing at. So as earnings go, price is going to go over the long term, but you can expect it to be bumpy during potential downturns. And we saw that here in 2020. Kind of seeing it now here, although that was a lot valuation based, which we'll get into. So as long as you buy this at a decent price, historically it's had predictable earnings. Now these guys have a lot of competition, and I think they're going to have increased competition, but they do have like niches, I think, that other companies like, well, any other kind of transaction company, but like PayPal or someplace like that, which I'm long now. They have advantages over PayPal, I think, with particularly when it comes to being connected with cards that have like rewards points and things like that. Um, the people who have the most money are usually using these type of cards either for business travel or for normal travel or for normal spending or for small business spending. And when you it creates a little bit of a moat, I think, because like when I look at my spending um now compared to maybe when I was younger, PayPal would have been just as equally advantageous to me when I was younger and didn't have as much money and didn't spend as much money once you have a family and everything. Um, Whereas if you're using like a reward system for airline or hotel points, which I do, or cash back, um, really you can get 5% of everything you spend back nowadays, almost, if you're using the right type of rewards and everything. So that is huge. And especially when you repeat it over time. So once a person starts doing that, I mean, when you get, I'll just give an example, like a Sam's Club card gives you 5% back on gasoline, and Amazon gives you 5% back on anything you buy on Amazon. And then there's a travel cards can give you enough points to, I took my whole family of four to Hawaii on points a couple years ago from United. So those are the type of things that these upstart competitors are going to have a very hard time like breaking through. So I do think Visa and MasterCard and American Express all have that type of moat going for them. Um, and so I think it's safer than the earnings growth in the future is probably pretty as safe as you can get, I mean, when you're making an equity investment. So while I wouldn't like bet the house on any particular one of these for like the next 20 years, over the next 5 years, it's very hard to see how they get totally disrupted from a competitor, I think. So pretty safe bet relatively to other stocks in the market is how I would describe it. So really, if we can look at earnings um, and project those into the future, which if you look at the future earning, I mean, you can see a 13, 13, 15 is what analysts are looking for. That's similar to what they've done in the past, which I'll show here in my calculations. We can just take earnings and what we're paying for the earnings with the earnings yield, which is the inverted PE ratio, and we can pretty much predict over the medium term and make a good estimation about what kind of returns we'll get on a stock like Visa. The one asterisk would be if there's a recession, and probably you want to be a buyer into if you can get one of these big sell-offs if it's deep enough, or if the recession's over, into a stock like this. All that seems common sense to some degree, but there are definitely stocks where this is not true. There's definitely businesses where this is not true. So in some ways, finding an easy to analyze business like Visa is actually pretty hard. And also it makes it harder to get deals on them because a lot of people, it's easier for them to understand. It has a good brand name, people know it, it's easy to calculate to some degree, and we can go from there. But here's my calculations. Let's see here. I have my earnings growth at, okay, let's start here. 13.68%. This was the historical trend. If you look at what I just showed you, where the future was, this is pretty much right where the future is expected to be by analysts. I don't think it requires any sort of special heroics to calculate that. And then that calculates to which is an earnings yield of 3.84%, which is earnings over price instead of price over earnings. It's the same thing though, it's just expressed a different way. So the way I think about this is, if I bought Visa's business for $100 at today's price, it would, now if the price goes down, this number goes up. So that's why the price matters where you buy it at. you would earn $3.84 a year on that $100 investment. And if you assume it grows at this $3.84 grows at 13 or 14%, which is the earnings growth number, what I do is basically add up 10 years worth of those earnings and see how much I would earn if I own this business. And if you buy it around today's price, you're looking at turning your $100 into $183. So you would add an additional $83. And I basically create like a CAGR calculation for that to see what that would come out for over 10 years. And no more. I don't assume anything after 10 years. Obviously, you would expect they would keep earning after 10 years, but it's hard to predict that far into the future. And this is really just a valuation method, right? So you get 6.24% 10-year earnings CAGR. My threshold to buy a stock is about 8% most of the time. And so it's not quite there. Usually like 6.5 would be like the midpoint of like a rough fair value. Visa is basically right there. I would consider this like fair value, where it's trading right at this particular time. But what I would say is the market is actually quite a bit more expensive for this. The last calculation I did on the S&P 500, it was at 5.18% CAGR at the beginning of the year expectation. Like same calculation I do here. I basically take a sampling of like about half of the S&P 500 that is not cyclical and use the same process that is actually in this spreadsheet. And I just look at what the weight, and then I weight them. This spreadsheet's equal weighted, so I have to weight them relative to the S&P 500 weightings. And when I do that, I actually get 5.18%. So for the S&P 500 estimate. So this is actually a lot cheaper. That's significantly cheaper than the average stock in S&P 500. So on a relative basis, if you are a money manager or you are a person who didn't hold any cash and you were just 100% invested all the time, this actually would be pretty attractive relative to the rest of the market here. And you're probably going to do pretty good with it relative to the market over the next like 5 years would be what I would say. But it's not cheap enough to get the type of returns that I try to aim for. So in order to get like a margin of safety, we're probably looking at about $162 per share. It's about 37% lower than where it is now. And then if it's a recession, especially if we know it's a recession, 153 would be where I would be aiming for, because we've seen how the stock can sell off deeper. It can give you a little bit more of a better opportunity. Still pretty similar, really. 35 to 40% lower than where it is now gives you a margin of safety. It's about fair value right now. And that's how I would summarize Visa. It's actually pretty interesting. I hadn't noticed that it was quite as fairly valued as it is. It hadn't quite gotten cheap enough to rise to the ones that I look closely at. But I think, if we got like a crash or a market correction that was really fast, this might become a buy. Definitely possible. Okay, thanks for watching. If you found this useful, hit the like button, hit the subscribe button. If you have a stock you would like me to analyze on the channel, just put it down in the comments. I'll get it on my list, let you know that it's on the list, and I'll eventually make a video. See everybody later.